Hi, and welcome to the 2020 First Quarter Investment Webinar with the San Diego Foundation. I'm Brian Zumbano, Vice President of Development and Stewardship. Thank you for joining us today. These investment calls are an enhanced service to you, our donors. The calls provide direct access to our investment leaders in a consistent, convenient, concise format, so donors can remain informed about the performance of their charitable assets. Today, we'll start with a brief macroeconomic update, followed by performance and attribution reports for our endowment portfolio and our long-term, medium-term, and short-term portfolios. We'll conclude with question and answer session. To submit questions, please use the unmute button, the chat function, or the raise hand function in the participants box located on the menu bar below at any time throughout the webinar. Any questions unanswered during today's webinar will be answered via email. Attendees can access slides and a recording of today's call at our website at sdfoundation.org by tomorrow. Leading today's discussion will be Steve Klosterman and Matt Fettig. Steve Klosterman is Regional Director at Halbert Hargrove and serves as Investment Chair for the San Diego Foundation Board of Governors. Steve advises a wide range of individuals and institutional clients and began his investment management career more than 35 years ago, building his own registered investment advisory business. Steve is past chair of the UCLA Foundation and a founding board member of the UCLA Investment Company, which oversees a $2 billion endowment. As chief investment officer for the San Diego Foundation, Matt Fettig oversees and manages our investment strategies and activities. This includes working with the board investment committee, senior staff, auditors, professional volunteers, fund managers, and outside consultants to establish, maintain, administer, and monitor policies related to foundation investments. Now, Steve Klosterman will get us started.
Well, thank you, Brian, and thank you, donors, for participating in the call. We appreciate your support very much. My comments, it says macroeconomic. They're really more macro stock market observations. The reason for that being there's an old adage in our business that you can't connect the economy and the stock market. I'll talk a little bit more about that, but we'll go with the first slide, which just, I think what I really want to emphasize here is that if you go back and look at intra-year declines, so that means a decline within the calendar year, that's what's represented by the pink dots. So to have intra-year declines is common. Virtually all years have some sort of intra-year decline, and some of them can be quite severe, quite acute. On the other hand, over 70% of the years ended up with a positive return. So you frequently get a false read, if you will, within a calendar year about the market. And a lot of people, and it's been proven, one of the studies is referenced as the Dalbar study, that basically people make these knee-jerk reactions and will decide a bear market's coming and get out and go into cash, and basically they end up shooting themselves in the foot. So I don't know where this year is going to end up by any stretch, but we've already seen an enormous rally. And back to my comment about the economy and the stock market, and you can check me on this, Warren Buffett, after 2008, in his report to shareholders, which happened to come out in February 2009, said the economy will be in shambles this year, but it also doesn't tell us anything about the stock market. Leave it to Buffett, the S&P was up over 26% that year in 2009, in which we had a really bad economy. So my advice, and certainly we follow it with the investment committee, is we do not try and confuse the economy and the stock market, and we certainly don't try and time the market, and I'll talk more about that, but we'll go with the next slide. This slide, and I apologize, I know it's kind of a busy slide. I really want to focus in on the left-hand side of the slide, which address bear markets, and it goes all the way back to 1929. So not only are these intra-year declines common, but bear markets are not uncommon, and the one thing they have in common is a really severe drop in the stock market. And when you look at the reasons behind those declines, they're always different. But the effect is always the same, a very big drop in the market. On the other hand, on the far right side, and this history has proven that the market always recovers. The issue is how long will it take to get that recovery? And we firmly believe that we will recover from this. Yes, it's painful. Yes, it's ugly. Yes, it's sad from a personal standpoint in many fronts, but we will get through this. And over a long-term time frame, 5, 10 years, we're quite comfortable that a diversified portfolio, the way we're doing it, will outperform cash. Next slide. This just shows back to that historical, stock market. It just shows where the market ends up, and you basically see it's certainly not linear, but the market always reaches at some point a new high, and that covers decades and decades and decades. And it's just important in these kinds of times to not be overly emotional, try and step back, be objective, and take a longer term view and not react particularly to media reports and pundits trying to predict where the market's going to go. Next slide. This is a very powerful slide about market timing. And if you only miss a few days of the best days, your return shrinks, and it steadily shrinks down and down and down to where you don't even beat cash. So one of the things we certainly do at the foundation is we do not try and time the market. That is not in any way incorporated. We run a highly diversified portfolio that has a high probability, no guarantees, but high probability that it will exceed certainly a cash return and earn pretty good real rates of return after you deduct inflation over 5 to 10 year periods. And certainly with the endowment, our time frame is perpetuity. It's forever. And the long-term portfolio is modeled to be endowment-like, certainly to have a 5 and 10 year time frame. And then for people who have more conservative objectives, we have a medium term and a short-term portfolio. So we've tried to create portfolios that are catered to the desires of our donors, but certainly those that are long-term focused can feel very comfortable with our long-term portfolio and the endowment portfolio and its level of diversification and ability to deliver over time pretty decent returns. So with that, I'll turn it over to Matt to get specific about some of those portfolios.
Thanks, Steve, and welcome everybody. We appreciate you joining us. Certainly, we have seen a great deal of volatility from the markets throughout the first quarter. It was scary for a number of weeks, as we know, around the COVID-19 crisis with markets plummeting. And while the focus of this webinar is really through the first quarter, I would say that March 31st data is really old news at this point. So bear with me. We will show you some exhibits through March 31st and through the end of the first quarter. But I also have an update for you as markets have really turned and performance has rebounded pretty dramatically. So if we focus on the endowment portfolio first, you'll see results through the end of the first quarter down 13.7%. As Steve mentioned, we are very long-term investors, and running an endowment investment portfolio really gives us the benefit of time. While we don't market time, and while we don't have a crystal ball that can predict the next recession or bear market, we've certainly positioned the portfolio to, number one, be able to meet our long-term objective of CPI plus 5%. But we've also constructed it with some assets that I'd categorize as diversifying and focused less so necessarily on growth, more so on capital protection. And so those assets are in these portfolios 4 times like the first quarter when we have significant drawdowns in the equity markets. You can see here longer-term performance numbers over the last 1, 3, 5 years have certainly been impacted by just the decline that we faced in the first quarter. Longer-term numbers at 5.5% over the last 10-year periods, which we still feel strongly about given the severity of the correction that we witnessed in the first quarter. The good news and the kind of more real-time update I have for you is through April 30th. And just in the month of April alone, the endowment portfolio was up 6.4%, recovering a significant amount of the losses we experienced in the first quarter. Furthermore, I'd encourage you to look at more recent results for the market. The MSCI ACWI index is an index that we follow that, much like the S&P looks at large companies in the US, the ACWI looks at large companies across the globe. Within the US, within developed markets like Europe and Asia, and developing markets like China, India, Brazil. And as of the end of May, that index had recovered so that it was only down single digits, just a hair over 9% for that calendar year-to-date period. So we have witnessed a fairly dramatic recovery in the equity markets since the lows we reached in March. Unfortunately, the first quarter was one of those environments where a lot of things that should have provided us some protection didn't work. Oftentimes we say correlations go to 1 in down periods. So in other words, we're trying to build a diversified portfolio of assets that have fairly low correlations to each other. But sometimes during periods of crisis, those correlations spike and everything falls at once. So you can see here we have some exposure to fixed income, typically an asset that would protect you during periods like the first quarter, especially with the rapid decline in interest rates. But even fixed income proved to be a very difficult environment if you had exposure to things like investment-grade corporate bonds or mortgages. Really, the only safe haven during the first quarter were U.S. Treasuries. We also have some exposure in that alternative section. You see 24.2% of the portfolio is in alternatives. And 15% of that is in what we call hedge funds. Hedge funds, it's a term that is often reflected fairly negatively in the press. It's an area of managers that charge higher investment fees and have had difficulties keeping up with the stock market over the last 10 years. But those managers are in our portfolio and play a very specific role for periods of volatility like we witnessed in the first quarter. And fortunately, we had 15% of the portfolio in names like that, which helped really protect capital. Yes, they lost money, but not to the same degree as the global stock markets. So with that, I'd like to flip forward to the long-term portfolio on the next page. Here we go. And you can see the long-term portfolio was down 16.3% for the first quarter, certainly impacting the 1-year, 3-year, 5-year numbers. To give you a sense, just in the month of April alone, the long-term portfolio was up 7.2%. So certainly has rebounded from the lows that we witnessed at the end of March. Many of the themes were similar. Equities across the globe declined significantly. We have about 20%, 19.5% in alternative investments, which were there to help protect the portfolio. The majority of them did a good job of doing that. But the one thing we have in the endowment that we don't have in this long-term portfolio, which requires liquidity, it requires frequent liquidity so that our donors can make grants at any time. In the endowment portfolio, we have illiquid assets. And those illiquid assets, we hope over long periods of time will generate superior performance to the public markets. But because they're not priced regularly, it gives you a little bit of a sense that things perhaps weren't quite as bad as they were in the first quarter. And without those illiquid assets here in the long-term portfolio, you can see the results not quite as strong as they were in the endowment portfolio. Flipping to the next page, the medium-term portfolio is really designed to offer donors with some growth from the risk assets in the portfolio. The risk assets are these blue sleeves you see in the pie chart: domestic equities and international equities. The rest is invested in bonds, fixed income, short-term fixed income, and cash. And here you can see with 30% exposure to stocks, this portfolio was still down 6.8% for the quarter. And as I mentioned earlier, while we would have expected bonds to protect a bit more than they did, they witnessed their own problems in the first quarter. Certainly as the Federal Reserve came in and offered some unprecedented stimulus and backstopping of the corporate bond market, we've seen a massive reversal from the last week of March to present. So to give you a sense of how this medium-term portfolio performed just for the month of April, it was up 4.8% in 1 month. That is a very dramatic move for a lower volatility portfolio like this. And so certainly we are now back closer to break even for the calendar year to date period on this portfolio, and hope the results will continue. And then last, I want to focus on our short-term portfolio. The short-term portfolio, it's important to note, is invested solely in U.S. money market funds. Money market funds offer you a yield. They're a cash alternative where you can invest your cash, take no real risk of principal fluctuation, and receive a yield attached to that. As the Federal Reserve cut short-term interest rates in the first quarter to 0, we're now back in a situation that we were in 10 years ago coming out of the great financial crisis, where money market fund yields have essentially gone to 0. So on a go-forward basis, we would expect this portfolio, while it's not taking market risk, will be yielding essentially next to nothing. So I would encourage you, if you are invested in the short-term portfolio, if a 0 rate of return is sufficient for your charitable dollars, then that's great. If it's not, I'd encourage you to talk to your donor manager and we can explore other options with your charitable dollars. Next page. So we have a bit of a new, a couple new slides for you here that I wanted to talk about. At our last webinar, I teased the fact that on January 1st, we launched 2 new investment portfolios for our donors. The first you're looking at here, it is called the Sustainable Endowment Portfolio. And this portfolio is focused on investing in global stocks and bonds, but doing so, paying particular attention to environmental, social, and governance criteria, otherwise known as ESG. We also took this portfolio one step further on the E side, the environment side, and asked our investment managers to divest from fossil fuel producing companies. So we only have 1 quarter worth of investment performance history, as these are new pools. You can see the sustainable endowment portfolio has $3 million in it currently. If you're interested in investing following environmental, social governance criteria and divesting from fossil fuels, you do have the ability to move your portfolio, and we encourage you to reach out to your donor manager if this is of something of interest. We can talk about it in greater detail. And then finally, the next slide is our non-endowment version of this what we call sustainable portfolio, also following ESG criteria and divesting from fossil fuels. $1 million in this portfolio as of March 31st. It is a new launch and something we'd be pleased to talk with you about should you have interest. So that concludes my remarks. I'll hand it back to Brian.
Thanks, Matt. Thanks, Steve. Now's the time for some questions. So as we mentioned earlier, if you have any, please put them in the chat section now, and we'll ask Matt. And haven't any yet, but as we wait, Matt, you had mentioned something a couple slides back, and in talking to some donors, I have a question that I'm hearing, at least. You mentioned the short-term portfolio is probably not going to move, and maybe they should move it over. I think everyone's trying to see what's going to happen with the market. Is this like 2008? Have you, Steve, Matt, ever seen a market like this where we can look at historical performance and get a sense, or is this unique in and of itself?
Well, given that we have Steve Klosterman here on the phone, who has many years of investment experience, I might turn that question over to him. And Steve, you're on mute at the moment.
Yeah, that's an excellent question, and one I frankly get in my own business a lot. I think it goes back, what I was trying to convey, certainly in one of the graphs, is if you look back at those bear markets, it's a very sobering average, which I showed you is down 42% on average. Now, averages camouflage a lot of volatility, but nonetheless. But when you look at it, there's an old phrase, one of the most dangerous phrases in investing is, this time it's different. Every time it's different. What's not different is the market has a huge drop in a relatively short period of time. Yeah, what's different about this is that it happened in such a short period of time. We've never had a drop. The peak to trough drop was 34%, and it occurred in about a month. That is unprecedented. But we've also witnessed a significant rally from that point. And there's also an old adage in our business, and I'm old, so I know all these old adages. History doesn't repeat itself, but it often rhymes. And so back to that rhyming part, I think this is different. Every one of those bear markets was unique in and of itself, but what was not unique was the market got hit real hard and it recovered.
Thanks, Steve. I appreciate that.
And there's another one too. It's come up. What do we do when a fund goes underwater? One of our endowed funds with the market increase, historical gift values probably, or actually maybe, Matt, if you could walk through what that kind of means. I know some on the call might not fully know what that means, and what do we do when that does happen?
Absolutely. So thank you, Brian. This is for our endowed portfolios only. So if you are an endowment fund holder, I'm happy to explain this in greater detail. Our primary job as endowment portfolio managers is to assure that we're producing a rate of return for the portfolio that protects the long-term corpus of the original endowment gift. We expect these endowment funds, they're given to us for perpetuity. We expect to be managing them for perpetuity. Hopefully, there will be people long after Steve and myself that are sitting in these same seats talking with you 60 years down the road about our endowment portfolio. And we're attempting to generate a return of the 5% spending rate that we allow from the endowment each year, plus inflation, because we know even benign inflation of 2%, 2.5% can make $1 turn into 50 cents over a 23-year time period. So we're attempting to generate this CPI plus 5 rate of return, which is a bogey that is hard to do in long-term investing. We're talking about 7.5%, 8% net type of returns, and it is a challenging environment to do that. We are responsible for protecting the corpus of the original gift. So if we do enter into periods of market volatility, we take what we call the historical gift value. The historical gift value is the amount of the original gift. So if a endowment fund holder had contributed $1 million, that would be the historical gift value. If there have been any additional contributions to that fund along the way, we would also include that in the historical gift value calculation. And in the event that the market caused a decline in the value of the fund holder's endowment below that historical gift value, instead of distributing the 5% that we typically distribute, we only distribute income, interest, and dividends generated by the portfolio. And we do that to protect that original corpus of the investment. And forgive me, as it looks like my internet connection is failing here and I was disconnected from Zoom, but I'm hoping you can still hear me. So that is historical gift value, and that is why during periods of market volatility, the spending rate on the endowment may go down. As market values recover and we're able to get back above that historical gift value, then distributions of that 5% rate will kick back in. I hope that, I know it's a little bit complex, but I hope that explanation made sense to everyone.
Great. Thanks, Matt. And we can hear you just fine. Thank you.
Great.
One last question. You mentioned illiquid investments. Could you please give an example of what an illiquid investment is? Oh,
sure, happy to do that. And Steve, feel free to jump in here as well. I'll start with one example, which is real estate. In the endowment, when an endowment gift is made to the San Diego Foundation, it is a permanent gift to the foundation, and it allows us to invest small portions of the endowment portfolio in things like private commercial real estate. So we will go out and we will hire investment managers that are specialists in real estate to go out and actually purchase portfolios of office buildings, industrial buildings, multifamily or apartment complexes, and build us diversified portfolios of actual real estate. Now, the alternative to doing that, perhaps in the liquid markets, would be to buy an REIT or a REIT. And a REIT is much like a stock, a public company that holds real estate assets and must make income distributions off of that real estate. And I don't want to steal one of Steve's adages. He has so many good ones, but the problem with a REIT is sometimes it behaves like a stock, sometimes it behaves like real estate, and sometimes it behaves like a bond. It does not always behave like real estate. So we'd much rather go to the capital markets and invest in a private real estate manager that's buying buildings, those buildings are liquid. You have to find a seller to purchase them. But essentially, they're not marked to market on a daily basis. Steve, I don't know, do you want to talk about private equity or venture capital or anything else?
Well, I'll just add, there's a premium for illiquidity. So the only reason you'd invest in an illiquid asset is if you expected to earn a higher return. Now, there's no guarantees, but with Matt's leadership, support from our consultant, Veris, specifically Shelley Heyer, and then input from our very astute investment committee members, we've done pretty well with our private investments and expect to do better over time. That area has the highest expected return, and that expected return comes from our consultants, not us, done right. So we're making the types of investments that Matt described, not just in the area of real estate, but also people who invest in our endowment own pieces of private companies through a fund that's chosen to invest and have ownership in those companies, and also in the venture capital area as well. And then, so that's why we do it. We're expecting higher returns and lower correlation, not perfect correlation, with what public stock markets are doing.
We have one last one too. Do you have attribution analysis for stock picking versus sector weights for your equity portfolio?
We do. Matt, do you want to go ahead and elaborate on that? Certainly on our index, the portion of the portfolio that's indexed is obviously going to be weighted like the respective index, but for active management, go ahead, Matt.
Sure. Good question, and that is something that we look at the investment committee level on a regular basis. Sometimes we struggle with, we have a lot of information on our investment portfolios, and we struggle with how much of it to provide to donors so as to provide enough but not to overload people with data. So I would encourage anyone that would like to see more data to reach out with it to us, and we can certainly share it. As far as directly answering the question, yes, you will find our philosophy is in areas of the market that we believe are efficient, and we believe that U.S. large cap stocks, for example, are efficient. We tend to buy low-cost index funds and invest passively. So you can really think about the majority of our U.S. large cap exposure, really all of the U.S. large cap exposure, to be invested passively in an S&P 500 fashion. Now, in the non-U.S. space, equity space, we think the markets are less efficient, and we particularly believe that in emerging markets. And that is where you will see us have higher investment managers that we hope can beat the market or the corresponding index over a period of time. And we certainly have attribution on each of those managers that we've hired in order to track them and monitor them with regular frequency.
Great. I have another one here. How has the sustainable endowment portfolio performed in comparison with the general portfolio since its inception?
Sure, I'm happy to take that, and I apologize, I'm still locked out on the internet here, so I can't see you all, and you can't see me, but Travis, if perhaps you could flip back to the sustainable endowment page, you'll see the sustainable endowment was down 13% for the first quarter. The regular endowment was down 13.7%. So I'd say it's a little bit too early to tell. Again, the sustainable portfolios are brand new. They started on January 1st. Certainly a little bit of outperformance from the sustainable portfolio. I'm not sure that you can directly attribute that to the fact that the portfolio managers are following these ESG criteria. I think it's more likely attributable to the fact that at the same time this COVID crisis started, there was also a large shock to the oil markets. And if you recall, prices really cratered in oil. And because this particular portfolio, the sustainable portfolios, does not invest in fossil fuel producers, it was able to avoid some of the carnage that was happening in that space.
Yeah, let me just add a couple of comments. All returns are beginning and endpoint sensitive. So it's the period of time in which you're measuring them. I will also say that, you know, risk shrinks over time in a well-diversified portfolio. And then my comment about there's a premium for illiquidity. If you want to ask the question, is there a higher expected return, no guarantee, on the endowment portfolio or long-term portfolio versus the sustainable endowment portfolio? Yes, there is. And actually a better risk-adjusted return because portfolios are more diversified. All things being equal, money compounds faster when returns are more consistent. You have more dollars at the end of the time period. So we look for a certain relative range of consistency, a tighter range of outcomes between highs and lows with our most diversified portfolios. So I guess in a nutshell, I'm saying I would not invest with the sustainable endowment portfolio with the expectation it will get a higher return. I would invest because those ESG factors are important to me as an investor.
Great, thanks, Steve. Thanks, Matt, and thanks for everyone for joining. We really appreciate it, and thank you for also partnering with the San Diego Foundation, where we're leading change today for a better tomorrow. Today's presentation will be available on our website at sdfoundation.org/investments. Thanks again, and have a wonderful day.